Good afternoon, everyone. I think that investors have a pretty good reason for feeling really quite scared right now. Last year, we saw rising rates, rising inflation. We've got the prospect of a recession next year. And also, we've got some pretty scary geopolitics as well. I think investors have good reason to feel quite scared. In addition, we had negative returns from global equities and global bonds. The last time we saw that was 1969. The last time we saw that before then was 1934. So these are unusual times. But my main message today is that this is actually a good time to be investing in global equities. And I'm going to explain why. But first, let me quickly introduce the firm I work for, Capital Group. So Capital Group is a specialist asset management company. All we do is manage money for our clients. And we've been doing it since 1931. So we had our 90th birthday just a couple of years ago. We manage about $2 trillion of our clients' money. Most of that is in equities. And that actually makes us the largest active equity manager in the world. So those are the credentials that I'm representing today. But now let me explain why it is that I think this is a great time to be investing in equities. And so this is the roadmap that we're going to work through today. So firstly, I'm going to try and put what's happening in markets right now in context. So I'm going to give you a framework for how to think about these scary times. Next, I'm going to talk about opportunities. And in particular, I'm going to talk about very powerful long-term trends and how that can lead to individual companies to invest in. And finally, I'm going to talk about outcome-focused investing, and I'll give you a tease. The short version of that is focus on the long term. So let's start then by trying to put what's happening right now in a framework that makes it a bit easier to live with. So it is likely that we're going to be having a recession next year in the US and in quite a number of larger markets. In fact, in Europe right now, we're probably already in a recession. But the question is, what does that mean for equity markets? Well, this is a situation where I think history can be quite helpful. History doesn't always repeat itself, but it does provide quite a handy guidebook. And what we're looking at here is data from the last 70 years. And in the last 70 years, we've seen 11 economic cycles. So basically, we've seen 11 recessions. And I think there's a few important lessons here. So the first lesson, if you focus on that green line, which is basically the economy, the first lesson is that recessions don't actually last that long. The shortest recession was 2 months. The longest recession was 18 months, but on average, it's around about 10 months. So might be painful when it's happening, but actually they don't last forever. The second lesson is that markets tend to see recessions coming. So the blue line is equity markets. And basically, markets forecast a recession around about 6 or 7 months before it happens. And in addition, they also forecast the recovery. So markets start to recover around about 6 months on average before the economy recovers. So what that means is you've got to be early. And the third lesson is that the typical sell-off in equity markets lasts for 11 months. And let me put that in context, that this sell-off so far actually has been going on for 12 months. So I think the takeaway from that is that, yes, we might see some more weakness in equity markets, but we're much closer to the end than we are to the beginning. So this is a time to be thinking about investing in equity markets. And remember that going through a recession and going through a bear market is nothing new. I mean, equity markets are always volatile in the short term, but in the long term, they have always gone up as well. So what this chart is looking at is looking back over the last 35 years, and the shaded blue area is the equity market. And all those words are highlighting the different crises that we've experienced. And there's a lot of crises which drive short-term volatility. We've got 2 Gulf Wars. We've got 2 attempts by Russia to invade different parts of Ukraine. We've got 4 healthcare crises. So we've got SARS, we've got bird flu, we've got swine flu, and of course we've got COVID. And then there's a whole list of different financial crises as well. But what you can see is that while there's short-term volatility, in the past the market has always ultimately gone up. And so the message here is that the patient long-term investor does get rewarded if they can look through short-term volatility. So the message here, once again, seems to be saying, get invested and then stay invested. But the question is, invest in what? And so let me pivot now to talk about some of the opportunities that we're seeing in equity markets right now. And the one that I want to start with is secular trends, long-term trends. So if we look back over the last 50, 60 years, we've seen a number of very powerful long-term trends which have defined different eras of financial markets. In fact, they've defined the world that we're living in. And if you can identify these trends, it's possible to invest very, very successfully. So for example, back in the 1970s, it was the energy crisis. And if you were able to invest in energy commodities, that was pretty rewarding. If you jump forward to the 1990s, it was the revolution of mobile phones. It was when we first saw mobile phones. Tech, media, telecom for many years was extremely rewarding for investors. In the noughties, we saw the reawakening of China, the integration of emerging markets into the global economy. Great way to invest for a number of years. And the last decade, it's been digital disruption. It's companies that are using the internet and technology to disrupt their industries, sometimes to actually create new industries. And so these are all good examples of secular trends. But the question is, what's going to happen next? So if we go to the next slide, I'm going to give you three possibilities that Capital Group is very, very focused on right now. So the first one, well, here I've called it industrial renaissance. Let me give it another name. Green energy transition. Next one would be regional supply chains. So we're seeing a lot of challenging geopolitics. The way that trade patterns work around the world is changing. That's an investment opportunity. And then finally, broad market leadership. So over the last decade, most investment game has come from a couple of companies in a couple of sectors. Moving forward, it's going to be much broader. So let me try and unwrap these a little bit more. And I'm going to start with the green energy transition. So the world is trying to commit to net zero carbon by 2050. Now, I'm not sure if we're going to make it. It might be more like 2060. But what is clear, that there are a lot of companies that are going to make a lot of money by driving this green energy transition. For example, electric vehicle manufacturers. We've seen some exciting returns from EV makers. What about the companies that make the batteries and all the components that go into electric vehicles? Renewable power. So companies that are creating power from wind, from solar, from other sources. That's an interesting investment opportunity. The companies that make the electrical grid that distribute that renewable power. But then also construction. So construction actually has a carbon footprint that is almost as big as the transport industry. And so what that means is that companies that can help lower the carbon footprint of construction, those are going to be interesting investments. It could be Caterpillar that makes big, heavy machinery. It could be Carrier that makes more efficient aircon, or it could be Sika that makes chemicals that are used in construction. So this is one potentially very powerful secular trend. Another one is supply chain reconfiguration, supply chain restructuring. So since 1990 until very recently, geopolitics didn't really matter that much because it was such a favorable geopolitical environment. But over the last 5 years, we've seen the emergence of a strategic rivalry between the US and China. And obviously more recently, we see Russia back in the fray. On one hand, this is super scary on multiple levels, but on the other hand, it creates investment opportunity. We're already seeing the restructuring of supply chains, and that leads to an opportunity to invest in companies that allow new factories to be built. Think about automation companies, for example. It also means that shipping is more complicated than it used to be, so dynamic shipping companies that can provide better shipping solutions. But what about the companies that have done a really good job of looking ahead and seeing the way that the world is changing and preparing for it? For example, Tesla. They make cars in the US, they make them in Berlin, they make them in China. They're quite well prepared. TSMC, they make most of their semiconductors in Taiwan. but they're also investing heavily in Japan, in Europe, and of course in the US, in Arizona as well. So that's an example of supply chain restructuring. But I also mentioned that investment gain is going to be much broader in the future than it has been over the last 10 years. And this leads to a wide variety of different investment opportunities. The one I've called out here is actually healthcare. It's a golden era of innovation in the healthcare industry, and pharmaceuticals in particular is very exciting. Lots of things I could talk about. The one that I'm calling out here is exciting new drugs for the treatment of obesity. Obesity is, well, actually it's reaching kind of pandemic proportions. The estimate is by the end of this decade, there'll be 1 billion people suffering from obesity, which leads to cardiovascular problems, other heart problems, kidney failure. And companies are just starting to come up with very powerful drugs that really try to treat obesity. And in fact, the most powerful drug has demonstrated that it can reduce weight by 20 to 25%. Very, very exciting investment opportunity. Something else to think about in uncertain times is the importance of having really strong foundations for an equity portfolio. It doesn't always have to be exciting growth. Sometimes it's just a really solid business that can build a stable foundation. For example, Nestle. It's a company that has a very strong portfolio of food brands. It has a record of continuing to grow through every single recession over the last 30, 40 years. Produces a return 10, 11% per annum year after year. Something very different would be London Stock Exchange. Doesn't sound like a stable company, but actually today around about 70% of their revenues come from selling data to investors like us who just need data to help with their investment decisions. And that data is sold on a contract basis. So it's renewable contracts year after year after year. Lots of stability to that business. And the final thing I want to focus on is dividends. And let me start by simply making the case for dividends. And I'm going to ask you to focus on the chart on the left-hand side of this page. And what this chart is looking at is returns on global equities over the last 30 years. And then it breaks the market out into whether or not companies pay dividends or not. So the first thing I want to highlight is that you can see that the non-dividend payers, so companies that just don't pay a dividend, they produce the worst return. So the implication is that dividends really matter. And you can see that with the dividend payers column, where it's actually produced almost the best return. But it's not simply a case of high yield. In fact, what's important when it comes to dividend investing is actually the sustainability of a dividend. So the ability of a company to pay a dividend and then grow it year after year. Those are the dividend growers. And actually, those are the stocks that have produced the best return. And by the way, the chart on the right-hand side of the page shows that these dividend-paying stocks, these dividend-growing stocks, have actually had the lowest volatility. They produce smoother returns as well. So I think dividends look interesting. But over the last decade, it's clear that dividends have not been in fashion. In fact, most of the investment gain over the last decade has come from more technology-oriented companies which perhaps don't pay dividends. And if you look at that column that says 2010s, what you can see is that only 16% of the return on equity markets has come from dividends. That is not normal. If you look across to the right-hand side of the page, you can see that over the last 100 years, dividends have usually made up almost 40% of total return, and it's likely that that's what we're going to see over the next decade, particularly as you can see in the 1970s, so that was another period with higher inflation, dividends actually made up most of the total return. So strongly encouraging you to think about investing in companies that pay dividends. Okay, so finally then, so what should you do? Well, my strong recommendation is for folks to think really, really carefully about what are your objectives. And I'm guessing that for most people in the room today, objectives are to do with saving for retirement, possibly saving to hand some money onto your kids. So we're talking about long-term objectives. And your investments should also be long-term. So let me map this out a little bit. And I'm going to start with this slide. And this tells a very clear story, which is that while we always worry about bear markets, bull markets matter much, much more than bear markets do. So what we're doing on this chart is looking back over 50 years or so, and you can see that the dark blue areas, those are the periods when we've had bull markets, when markets have gone up, and those are pretty big shaded areas. And then the bear markets are those small green areas. Now, of course, bear markets always hurt when you're living through them, but in the grand scheme of things, the most important thing is to make sure you're invested in those bull markets. And we got some handy numbers to summarize this a little bit more. So over the last 50 years, we've had 6 bear markets. Typically, the bear market lasted around about 1 year, so 13 months, and a bear market went down by around about a third. Very painful when it's happening, but it was just a third. Now, in contrast, we've had 7 bull markets. The bull markets didn't go on for just 1 year. They actually went on for 6 or 7 years. And they didn't go up just 35%. They've actually gone up on average 254%. So the most important thing as long-term investors is to make sure you're invested in equity markets so that you can enjoy these big bull market returns. Now, you might be tempted to say, yeah, I want the bull market returns, but I think I can time the market to make sure that I miss the bear market so I can have my cake and I can eat it too. The challenge is that timing markets is really, really hard, even for the most expert professionals. And one of the challenges here is that investment gains, they don't happen steadily over time. They're actually concentrated into just a few days. And I've tried to bring it to life with this chart where we're looking back over the last 10 years and we're looking to see what would have happened if you had invested $1,000 in the equity market 10 years ago. And the answer is, if you look at the left-hand side of this chart, the answer is you'd have tripled your money. So a pretty good outcome, $1,000 going to $3,000. However, if you had tried to be smart about market timing and you had not done a good job of it, and by the way, most people don't do a good job of market timing, and let's say that you had missed just the 10 best trading days over that 10-year period, you wouldn't have tripled your money, you'd have only doubled your money. So 10 days make that much difference. If you'd missed the 20 best days, actually, you'd have only made $600 on top of your original 1,000. Now, you might still say, okay, I still think I can do market timing. But the final challenge I'm going to lay out is that those really strong days when you make most of your investment game, they don't come easy. They're really hard to find. In fact, if you look at the 40 best days over the last decade, 30% of them didn't happen in a bull market, they happened in a bear market. And another 30%, they actually occurred in the first 2 months of a recovery. And remember, that's usually when the world is still in recession. So it's very hard to find these really hot days. And so pretty strong message here, which is saying that market timing is not a good idea. And instead, being invested and staying invested is the way to go. And the final point I want to lay out here then is that actually this long-term investing approach really does lead to stability. So looking back here over the last kind of 15 years or so, if you look at all of the different one-year periods over the last 15 years, 70% of the time over one-year periods you'd have made money, 30% of the time you would have lost money. But if instead you extend your time horizon to be aligned with your objectives, so for example, saving for retirement, so let's say you look at 10-year periods, 100% of the time, you'd have made a positive return. And so you can see I'm working this pretty hard, strongly encouraging folks to get invested, stay invested, and not try and get too smart about market timing. So I do want to give you just one final piece of advice. So I've spoken a lot about financial markets, but I now want to talk about fund managers. So the fact that you're here at a fund supermart event probably means that you're interested in partnering with a fund manager. And my final piece of advice is simply to be very careful about the manager that you partner with. And I'm making the case that Capital Group is a good partner. Why is that? Firstly, because our interests are aligned. We only do well if you do well. Our portfolio managers, they're not paid based upon how much money they manage. They're paid based upon investment results. They only get paid if they first make a lot of money for our clients. So I think that's the first point I want to make. And And the second point is just global strength and scale. We've been managing money for more than 90 years. We have 30 offices around the world. We have 8,000 associates working to improve the lives of our clients through successful investing. Now, obviously, I would say that, wouldn't I, because I work for Capital Group. So my final word will be to instead ask you to listen to the independent experts. So Morningstar, arguably the world's, or one of the world's most successful fund rating agencies. Last year, they named Capital Group as the best asset manager in 12 countries across Europe and Asia. So I encourage you, if you won't listen to me, do please listen to Morningstar. So I close by wishing you luck, not just for 2023 investing, but actually for the next decade or so of investing as well. Happy long-term investing.